Hey everyone, welcome back to Corporate Decoder. Today, Ligand Pharmaceuticals Inc. just filed an 8K, and I'm seeing a shift in their debt agreements that signals increased flexibility. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is rearranging its debt to potentially fund new growth or return capital, and the terms are changing significantly. Ligand Pharmaceuticals, ticker symbol LGND, is a company that develops and licenses products. They recently filed an 8K, which is a report for significant events that happened between their regular financial reports. The main story here is about a change to their credit agreement. Think of a credit agreement as a rulebook for how a company borrows money. Ligand has updated this rulebook with a fourth amendment. This is important because it shows how the company is managing its debt and borrowing capacity. This filing tells us that on the 22nd of June 2026, Ligand entered into what is called a consent and fourth amendment to credit agreement. This document is essentially an update to the original loan agreement they had with banks. The key players here are Ligand as the borrower. Certain of their subsidiaries who are acting as guarantors, meaning they promise to pay if Ligand can't, and Citibank NA as the administrative agent, which is like the main banker in charge of the loan. Now, what is actually changing in this agreement? Two big things are mentioned. First, this amendment is designed to allow Ligand to issue convertible senior notes. These are a type of debt that can be turned into stock, and the company is planning a pretty sizable offering of these. We will talk more about that in a bit. Second, and this is crucial for understanding how they are managing their finances, they are changing the minimum financial performance requirement. Specifically, the minimum consolidated EBITDA, which is a measure of profitability, is being lowered for several upcoming quarters. For the periods ending the 30th of June 2026, the 30th of September 2026, the 31st of December 2026 and the 31st of March 2027, the minimum required EBITDA will be $100 million. After that, it increases to $150 million. This lowering of the EBITDA requirement suggests they are giving themselves more breathing room in case their earnings are a bit weaker than previously expected, allowing them to avoid breaching their loan covenants. This is a common move when a company plans for significant new debt or investments. This leads us to another important piece of news buried in this filing. On the same day, the 22nd of June 2026, Ligand also announced a proposed offering of $550 million in convertible senior notes that will mature in 2031. This offering is being done as a private placement, meaning they are selling these notes to a select group of investors, primarily qualified institutional buyers. They are also giving the initial buyers an option to purchase an additional $82.5 million of these notes. This means Ligand is looking to raise a significant amount of capital, potentially up to over $630 million in total. If you own Ligand stock ticker LGND, this is what you need to pay attention to. Issuing convertible notes can have a dilutive effect on existing shareholders. While it provides the company with funds, if those notes are converted into shares, it will increase the total number of shares outstanding, potentially reducing the ownership percentage of current shareholders and impacting earnings per share. The company is currently trading at a very low price, as indicated by the $0.04 current price and 52-week range. This offering of new debt, especially convertible debt, can be a signal of future dilution or a way to manage existing debt obligations. Given their small employee count and the low stock price, this move to raise capital is significant. The actual details of this amended credit agreement are attached as Exhibit 10.1. This is where you'd find all the legal nitty-gritty, but the key takeaway from the filing summary is the adjustment of financial covenants. Also included is a press release announcing this offering of convertible notes, filed as Exhibit 99.1. This press release likely contains more optimistic language about the use of funds, perhaps for business development, general corporate purposes, or potentially share repurchases, though with the current stock price, share repurchases might be viewed cautiously. Finally, the filing lists the exhibits including the amendment to the credit agreement and the press release. Now, let's put this all together. Ligand Pharmaceuticals is actively managing its financial structure. They are amending their credit agreement to accommodate a large offering of convertible senior notes, and crucially, they are relaxing the financial covenants related to EBITDA. This suggests they are either anticipating a period of lower profitability or are strategically positioning themselves to take on more debt for growth initiatives without tripping loan defaults. The $550 million to $632.5 million in new capital from the convertible note offering is substantial, especially for a company with only 47 employees and a very low stock price. Historically, companies that issue significant amounts of convertible debt often do so when they foresee growth opportunities that require capital, but also as a way to deleverage or improve their balance sheet over time. However, The risk for existing shareholders is dilution if these notes are converted into stock. For example, if a company like Ligand, trading at such a low per share price, were to issue a large number of shares through conversion, it could significantly dilute the value of existing holdings. Consider if a smaller company like Crystal Pharma, which has also navigated debt and financing challenges, had issued a similar percentage of its market cap in convertible notes. It would have drastically altered its shareholder structure. The adjusted EBITDA requirements are a key indicator here. Loosening these covenants is often a proactive step to maintain financial flexibility. It is like getting a bit more time on the clock before a penalty is applied. Without this amendment, a slight dip in earnings might have put them in violation of their loan terms. What does this mean for Ligand? It appears they are preparing for significant activity, possibly acquisitions, new product developments, or restructuring. The convertible note offering provides them with capital without immediately impacting cash reserves as much as traditional debt, and with the possibility of future equity conversion reducing the debt burden on their balance sheet. However, the long-term impact on existing shareholders hinges on how effectively management deploys this capital and whether the company can grow its earnings to support the conversion of these notes or ultimately pay off the debt. My biggest concern is the potential for significant dilution given the company's current market capitalization and stock price. While raising capital is necessary for growth, the structure of this offering warrants close monitoring by shareholders. What I'm actually looking for is how this capital is deployed and if it leads to tangible improvements in the company's operational performance and profitability metrics beyond the adjusted EBITDA. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives.